I'm Marella Fernandez. Thanks for joining us here on Market Call. Darren Sissons in-house today, partner, portfolio manager, Campbell, Lee & Ross Investment Management stocks, and he'll be taking your questions on global and technology stocks today. Here's how to reach us, 1-855-326-6266. You can also send an email to marketcall@BNNBloomberg.ca. Darren, thanks, of course, for coming in. Lots to talk about today. Of course, we have to talk about tariffs first and foremost. The Prime Minister gave a very blunt address to Canadians a short time ago, talking about the decision by the American president to impose the tariffs. Canada, of course, retaliating with $30 billion worth of American imports. Investors are watching this, probably hearts sinking a little bit on watching the markets go red. What's your big picture advice for investors today?
Big picture advice? Well, you're starting with the easy question,
of course.
So I think there's always a couple of considerations when you're constructing your portfolio. And the first thing is capital preservation is really key. And I think in the last few years, with a lot of very easy monetary policy, a lot of printing, and then fiscal policy where there was lots of money from the government, it was just making money in the markets looked easy. Whereas now, it's difficult. So capital preservation, first and foremost. And I think secondly, investors need to think about, are they positioned appropriately for the environment we have moving forward? So they're going to have to look at their portfolio and say, okay, this name that worked, for example, in the last few years, perhaps it's time to change that one out and add something else. And we're going to see, if this sell-off continues, we're going to see some very significant opportunities to buy really high-quality franchises and some of your wish list names. And if you can get those at very attractive prices, that's going to be ultimately very helpful for the portfolio moving forward. So keep those key considerations in mind. And in terms of capital preservation, just to cycle back to that, if you don't have derivatives and you can't use options, then you raise cash and you have some cash, and when you've got cash sitting aside, then what you can do is then take advantage of opportunities when they present.
So talking about wish list, I've been keeping an eye on the 7 today just to see where that's going. And NVIDIA at one point was down 10%, Meta down about 6%, Tesla, of course, down 9%. So those are being hit, obviously, very clearly. I'm just wondering, given China being included in the tariffs as well, do you expect that they will go down even further?
China? Well, let's look at Trump.
The stocks, because China's being hit by the extra 10% tariff today.
Well, I think the answer to that is if you look at Trump 1.0 the first time around, the Chinese just devalued their economy, they devalued their currency, their global market share and their global foreign reserves increased, and their tech giants got even bigger. So the sanctions did not work. And so from an exposure point of view, the issue is more likely whether or not the Chinese put sanctions on US companies. And if so, how meaningfully, from an economic footprint perspective, that is. In terms of wish lists, right now, let's recall that NVIDIA in 2022 went down 70%. So there's a lot of air in those tires. And so if you're going to have exposure to those names, perhaps now is not really the right time to look. You want to watch and see what happens. We need a floor. And then after the floor is in, then you can look and see to develop your allocation. But taking some profits, like if you've owned NVIDIA for 10 years and you're sitting on huge gains, there's nothing wrong with taking some money off the table. And you need to look across your book, because I think in the last couple of years, everyone's allocations are overweight. So trimming some of your winners, raising a little bit of cash, these are the types of activities that I think investors want to be thinking about.
Okay, I'm sure there will be a lot of questions today for you. Sure. We're going to be back with Darren Sissons in the show, partner, portfolio manager, Campbell, Lee & Ross Investment Management. Taking your questions today on global and technology stocks. We'll line up the phone calls and be back in just a moment. Welcome back. Thanks for joining us here on Market Call. I'm Marella Fernandez. We are going straight to your questions today. Greg has sent an email from Oakville for Darren. He says, I would like to hear Darren's thoughts on Mondelez in light of the recent pullback and merger talk. So Mondelez in the question today for you. What do you think of Mondelez?
Yeah, so Mondelez, for those who perhaps don't know, was spun out of Kraft. And then there were two components. You had Kraft Heinz, and then you've obviously got Mondelez. Mondelez has been the better performer. It's looking to obviously to buy Hershey's, which will be a sizable acquisition for them. And obviously there's been a sell-off in terms of the market just generally. But I think that if investors are thinking about risk off, they're thinking about whether or not they should have exposure to some staples. Mondelez looks reasonably attractively priced. From our point of view, it's probably not a name that we would put across the portfolio.
Okay.
In terms of that space, I tend to prefer Lindt chocolate, but it's about $17,000, $18,000 per single share.
Wow.
Yeah. So, and it has outperformed. So, great category. I like the staples at this point in the cycle, and they have very, very inexpensive because in recent years, obviously staples have been not being the flavour of the day, so you can get exposure to the category quite inexpensively.
Yeah, cocoa has been a problem. Okay, let's go back to another email. This one is coming from Sue in Penticton. And Sue says, what sort of growth do you see for Propel Holdings? Is this momentum or fundamental driven? Could it be a takeout target is what Sue wants to know.
Yeah, so this is a company that, let's call it a fintech enabler. And typically, the challenge that I have with this company is it's actually quite, I think it would IPO'd around 2018, if I remember correctly.
Okay.
Has had a great run, has grown. But typically, non-bank allocations tend to be lesser quality clients. And if you get a recession, as we might look like we're going to get a global recession based on what we're seeing out of the Trump administration, then those types of clients tend to underperform from a credit metric, larger charge-offs and things like that. So, we would probably want to see this company through at least one business cycle, complete business cycle, before we'd take a look. But definitely recent performance has been great. But for us, I think it's just a wait and see. So it's a pass.
Got it. All right, let's go to the phone lines. We have Bill on the line, and Bill is calling today from Bowmanville, Ontario. Hi, Bill. What's your question today?
Thank you for taking my call. I'd like your guest thoughts on KKR, and does he think it's worth holding? Thank you.
Okay, KKR.
KKR, yeah. Back in the day, I used to have allocation to KKR directly.
Okay.
So I know the company pretty well. I've actually met Henry Kravis and his partner.
Oh.
Yeah, she had an elevator at one point and even shook my hand. So know the franchise pretty well. I think the whole premise around asset managers, whether it be Brookfield here, whether it be KKR or a number of different firms, and there obviously are examples also in Europe as well. The question is, have they got sufficient cash? Have they raised sufficient cash, particularly when you go into a recession? So when you go into a recession, you get to deploy capital at inexpensive prices,
okay,
and then ultimately you sell them as the economy improves and you've worked your magic. So I think the franchise is a good franchise. The question I would perhaps ask is, from a risk-adjusted perspective, given the US dollar cost base, would you want to buy KKR versus perhaps buying Brookfield locally and not paying that extra premium? So that would be a consideration. And then there are also some names in Europe that you might want to look at.
Was that up 400% in 5 years? Was that can we go back to that 5-year look for KKR as well? There we go, 5 years up 400%. Wow. Okay, so it really has had a lot of growth.
So cycling back to that, do you think the next few years is going to be the same?
Got it. Okay, good point. Let's move on to the phone lines again. Peter is on the line from London, Ontario today. Hi, Peter. Do you have a question?
Yes, I do. Hi, Darren. How are you doing there? I've got about a half dozen liquor stocks, and in the last couple of months, they've all tanked significantly. First of all, your comments on the industry generally regarding that. And secondly, more specifically, your comments on Brown-Forman. That's the major bourbon distiller in the States, and today seems to be an appropriate time to ask a question about them. Your thoughts, please. Thank you very much.
Sure. So the point that I would flag in terms of fundamental performance, apparently the millennials are not drinking as much as the people my generation and older did when we were younger.
I think that was clear a little while ago. And very early on, they sort of came out and they just weren't doing the drinking that the older generations were doing.
Yeah, and I think that's correlating in why they're still single. Because a lot of people met their partners at the bar and things like that.
Remember, they didn't socialize the same way either, right? A lot of it was online.
Yeah, you nailed that point. So I think, but fundamentally, I think that people's consumption patterns have changed. They're not perhaps going out so much in terms of restaurant. They might be consuming at home, perhaps drinking more wine. As you get older, the conversation is you've got to drink red wine as opposed to beer. And then you go back the next year to your doctor, you can't drink the same amount of red wine as you will with beer. So
you can't drink anything.
Yeah, but I think fundamentally this is an industry that tends to perform better during recessions. People unfortunately tend to drink a little bit more. In terms of Brown-Forman itself, what I would perhaps question is that the Chinese sanctions were targeted directly at the states that Brown-Forman, which is the Jack Daniel's franchise, and it hurt them quite significantly. So it is an excellent franchise, but the stock really hasn't been going anywhere for a while. If you compare it to, for example, Diageo, if I remember correctly, Diageo has significantly outperformed it. The other challenge with Brown-Forman is you're using Canadian dollars at a 40% premium to buy a quality US name. Perhaps you want to look at David Campari and Louis Vuitton has the Hennessy assets. There's a number of different opportunities where you don't have to spend as much in Canadian dollars to get the same exposure.
We've also heard from some of the premiers they're pulling American product off the shelf. So I'm wondering if that sort of factors in moving forward.
Yes, obviously that's going to be a consideration, and bear in mind the LCBO is the single largest global buyer of product. So it will have a meaningful impact, but again, Jack Daniel's is consumed in many, many countries as their franchise. So the big driver for that franchise will be if they pull off another acquisition. And there's not many marquee acquisitions left to buy.
Got it. We will be back with Darren Sissons from Campbell Lee and Ross Investment Management taking your questions today. We're going to take a quick break, but back in a moment. Here's how to reach us if you're trying to call in or send an email. Back in a moment. Thanks for joining us here on Market Call. We have Darren in-house today. He's taking your questions, and Rob has been holding on the line from Calgary today. Hi, Rob. What's your question today?
Hi. Thanks for taking my call. I'd be interested in hearing Darren's opinion on HSBC. I don't see much coverage on foreign-based banks outside of the U.S., and I've held the HSBC for a number of years. So I'd like to get Darren's take if this is a buy, hold, or sell. Thanks again, and have a good afternoon.
Where do you stand on HSBC?
So HSBC has, in a few different cases, has run into a few sharp objects, and it's also had some obviously some headline risk. For example, they were the first European bank to cut the dividend during COVID, and they got punished the most, whereas everybody else did the same thing. So it's from a customer perspective, I think it's a great it's a great bank. They have obviously left Canada now, but I think it's a good franchise. But it's probably not the bank that I would buy in Europe. And if you're sitting on the kind of gains and you bought it sort of in the 2021, 2022 range, you've done fairly well. But if you go back further, it's been quite a lumpy story. Probably not as well run as, for example, Royal Bank, the Canadian banks here, National Bank, and so forth. So if you're going to look for an opportunity, a global opportunity to buy a bank, you want perhaps a cheaper price with a higher growth rate and so forth. So a name that comes to mind would be Shanahan Financial out of Korea. That's actually quite inexpensive. Crédit Agricole in France actually has a very hefty dividend. And then in Europe, you've got, in Northern Europe, you've got Nordea, you've got Handelsbanken. So there's a few different opportunities. HSBC, it's a nice name, but just because you can buy it as an ADR, don't just default to that because it's easy.
Got it. All right, let's go back to the phones. John's on the line from London today in Ontario. Hi, John.
Hello, Darren. I'm watching the reactions of the Mag 7 to this Washington act of tariffism, and I'm wondering which of these stocks is likely to withstand this assault and come out making gains again. Thanks very much.
We touched on this at the start of the conversation. Some of these stocks have been hit pretty hard today, in the last few days, actually. What's your take?
Yeah, so let's sort of step back and say, look at what happened in 2022. NVIDIA went down 70%. So there's a lot of error in a lot of the tires because what's happening is the passive ETF flows are just continuing to buy the same names over and over and over again with complete disregard of valuation. So if the sentiment turns because investors start swapping their growth ETFs and perhaps putting on a little bit more risk, then the magnification of those selling will then be more significant. And so what I would say is, I think they're all generally good companies, but the valuations have been nosebleeds for a long period of time. Like Meta, like what is it? It's Facebook, right? And I can message my mother back home in New Zealand cheaper via its application, or I can share pictures. But fundamentally, what is it going to do for me? And I think that investors need to start thinking about what is the offering. Is it a sustainable business model, and what is an appropriate valuation? I think many investors are going to start asking those questions here. So if you don't have exposure, or you have some exposure, perhaps trim and take some names off the table here. It's probably the best question. So I think it's too early to say which one's going to hold up best and whether it's a buy the dip type of scenario, because the dip's not in yet.
Got it. All right, let's go back to the phones. John on the line. He's calling from Toronto today. Hi, John.
Yes, good afternoon. Darren, would Novo Nordisk be a candidate for a wish list? If not, do you have another name that you would prefer in the pharmaceutical sector? Thank you.
Novo, very popular.
Novo, yeah. Oh. So, we were fortunate enough to buy Novo Nordisk in September of the first Trump administration before he got the keys.
Okay.
So we've owned it a long period of time. We've trimmed it. So if you look at the long-term chart, it just went vertical.
Yeah.
Obviously, obesity was the driver, but underlying the franchise around diabetes is actually a very, unfortunately, it's a growing business. Right. And
aging population.
Aging population, yeah. So it's given back a little bit recently, but and some of that concern was that they could not hit manufacturing throughput just because purely the demand, it was outstripping demand. They made some investments, that's been fixed. But the underlying issue with regards to obesity through diabetes has not gone away. So at these levels, I think it's attractively priced. Being down 29% after we've cut it 6 times in 9 years, I think 7 times in 9 years, to trim it, keep it back to weight. I think it's reasonably priced here.
Great. All right, let's go back to the phone lines. We have a call from Sierra Vista, Arizona, I believe. Taraver, do you have a question today?
Yes, and before I say anything, I'm also a Canadian citizen, so please don't cut off my call.
Very, very important point to make today. We appreciate that. Thank you.
Thank you. My question is on Lam Research, Mr. Sissons. And I know you've actually followed the semiconductor industry for many, many years. I remember way back you invested and you did very well. But is it that time again for this company, which does wafer technology for the semiconductor industry, or does it have to drop even further? Thank you.
Okay, so there's a couple of dynamics at play here. So you've got a semi-cycle, and then you've got a new business line that's come along. So anything that's AO related in terms of semiconductor space has rocketed north. Anything that's not, or perhaps doesn't have semiconductor exposure, is running through a conventional semiconductor down cycle. Because obviously during COVID there was a lot of pull through. So demand is very weak, particularly from auto, consumer electronics, as people loaded up and got the new TV and things like that. So that's one dynamic, and the second dynamic is really what the Chinese are doing in terms of building their industry. So there was a big demand from China until the semiconductor sanctions were put on, and that caused some of the semiconductor names to sell off. So the question is displacement of vendors. So I've met with Tokyo Electron, Lam Research, talked to Applied Materials, ASML. And while I do like the space, I think there's a little bit of air in that market as well. So the preferred name, and we don't own it, would probably be ASML, or perhaps one of the packaging names like a Kulicke & Soffa at this point. But Applied Materials, Lam Research, ASML, I think if you get a good entry price on these, they're good long-term holds. And you can see the chart is very lumpy.
Got it. All right, we do have to take a quick break here on Market Call. We're going to return with our guest and look at past picks. That's coming up. Welcome back. Darren Sissons is in-house today. He has past picks we want to take a look at and see how they did. These past picks are from February 9th, 2024, so just over a year ago. We're going to start with BHP, which was 60.18 at the time, now dropped to 48.69, 19% return and 15% down return in total returns. What happened with BHP?
Commodities happened, obviously tariffs. But I think what I would say is if you just look at technical levels, typically whenever we buy this below $50, it tends to run. So just over 2 years ago, we took half of the, you can see it in the spike in the chart. So we took half of it off at $70. So the way we treat commodities, we don't have a lot of commodities in the books, is we tend to run with a relatively small allocation, and then when we see it start to move, we push a lot of capital in. So from a technical level, I would say, because I think this is a technical cycle here, I would say that if we see it into sort of anything around the $45 range, we'll probably double the position. But it's global best of breed. They looked to buy Anglo-American fairly recently. They haven't pulled that off. So if we see weakness in commodities, they'll be active on the acquisition front. So, we wouldn't be selling this here. Although, given what happened, it's just flavour of the month.
Yeah,
considering everything that's happening.
All bets off the table at this point with Donald Trump in office. Yeah. Okay, let's go to your next past pick, which was Royal Bank. Again, this was February of last year. At the time, it was 131. Now it's at 163. So up 25%, up 29% with dividend total return. Of course, it's Royal Bank.
Yeah, so what can I tell you that tell investors that they may not know about Royal Bank? Obviously I'm an ex-RBC guy myself. Good franchise, but one of the things that I think is a driver is it holds the number 2 position in the Canadian ETF, financial ETF. So any passive flows into that, regardless of what it's doing, is going to benefit. I think it has a 21% weight from memory. So I think that's going to be a driver considering the flows into passives. But it's good quality franchise. We would buy it for new clients here. And I'm not overly concerned with the credit losses and things like that, because I think most of the banks globally after the global financial crisis are now very well capitalized. So I think this is a great opportunity.
Yeah, all of the banks are upping their credit losses. And are you concerned, considering the tariff war essentially now that we're in, that we're going to hit that sooner than later?
So where the issue becomes in terms of a credit risk is they actually take a provision and then actually when they've executed, they execute losses against that. That's an erosion of Tier 1 capital. But if you look at where Tier 1 capital is, and various capital buffers and counter-cyclical buffers and various so forth, the banks are very, very well capitalized. Almost 2x what they were in 2008. So I think the question of systemic risk, credit losses and those types of risks for banks globally is much less. And we have a very well-regulated market and well-capitalized banks. So I'm not overly concerned at all.
Got it. All right, let's move to Shell, which was their third pick from last year in February. At the time, it was 63.74, now 65.59, so a hike of almost 3%. Total return of 8.5, so they do pretty well with dividends, I guess.
Yeah, and so, again, very well-known company. 2 things that I would flag. They've sort of exited largely the renewables business because it just didn't pay. We're obviously in a relatively interesting environment for commodities, as we saw with BHP. They're buying back $3.5 billion worth of stock a quarter. So I think longer term, we're going to see the total return for shareholders improve. And any reduction in share price plus and share count plus an increasing dividend just drives better total return. So at these levels, I think this is very, very attractively priced. But I'm talking long-term exposure. I wouldn't be, if you're looking to trade resources here, I can't tell you what's going to happen next month, but over 4 to 5 years, this will be an accretive investment.
Got it. I think we are going to head to a break right now. We're going to be back with more of your phone calls and your emails here on Market Call in just a moment. Welcome back here to Market Call. Thanks for joining us today. We want to go straight to your questions. Chad has sent in an email from Vancouver, BC. He says, I bought shares of FLJP. It's traded sideways for a while, it's out of Japan, I guess. I'm trying to diversify outside, as Darren has suggested. Is Japan a good place to invest, or is there a better market that he can suggest? The state of Japan and where you should look overseas.
Yeah, I think this is a general question. Given the market environment has changed, I think a lot of investors are starting to think about, non-Canadian exposure. Yeah. So we don't actually invest in ETFs, but I will give my comment on this. So if you look at the holdings of that ETF, actually really top tier blue chip Canadian Japanese companies. Probably the one I would call out would be Tokyo Electron. Is in there, and it's a great company. But I think the challenge with the Japanese market, if you look at it in the performance, relatively speaking, relative to other markets, it hasn't done that great. Okay. And so you might want to look at another region. So, I think there's a lot of good quality opportunities in Europe. I would probably say look at Europe rather than focus on Japan.
Okay. That is good advice. Let's go to the phone line. Anne is calling on the line from Scarborough today. Hi, Anne.
Oh, well, good afternoon. Darren, I realize it's sort of David versus Goliath, but I'd like your thoughts on Intel. Should I buy more, hold, or sell? Thank you.
Yeah. So good question, Anne. So if you're really, Intel's really a story of to quote Andy Grover was the prior CEO, only the paranoid survive effectively, and the paranoid didn't survive. Okay. So they missed the mobile ecosystem, and really ARM Holdings has really killed them ever since. And they just really have been just one train wreck after another. So at this level, I think that this is a company that's in terminal decline. You may be able to get a dividend out of it, but it's just not a place you want to be. There's very little growth moving forward unless something fundamentally changes. It's ultimately going to be acquired. There is talk that Taiwan Semi would acquire them, but I just think antitrust and a whole number of other issues would get in the way. So I have no reason to add Intel here, and I would suggest that and you might want to think about taking your losses here.
Got it. All right, let's go back to the emails. This one is from a viewer named Ro, who says, hi, can you let me know what your guest thinks about Axon in terms of selling, holding, or buying on the dip? I bought it a couple of months ago, and the price rose a bit. Now it's fallen drastically. As a result, I have a huge loss. Does your guest own the stock?
As a global comment, in this environment, this type of risk environment, if you've got a loss, take the loss. It's an asset. It's a tax asset. So that's the first thing I would do. Talk about Axon is a company that provides body cams, tasers and things like that. And that's just a product replacement cycle. As global police forces and related affiliates, related types of businesses tend to upgrade, then they will get their market share, but at a 40% cost premium to who other vendors in the market. So the stock is sold off. I think the valuation was very expensive. And then for me, it's a pass here. I think those products can be bought elsewhere.
Got it. All right. Let's go back to the emails. We have another one from Mike. And we touched on this earlier, but he says, I would like to get your guest's opinion on Taiwan Semiconductor, which has been making news a lot. They announced a build out in the U.S. Yeah.
Okay. So I think firstly on that announcement, I think the TSMC boys just kissed the ring and said that they're going to, they also say that they were going to build a plant in the US a couple of years ago. And then what actually happened was permitting, labour, and a number of different factors. So it was going to cost 6 times more and be more expensive and not be as productive. And I think that perhaps the Trump administration are kidding themselves if they think that the most strategic company in Taiwan is going to move IP of strategic importance, probably national importance, to the US and so they can manufacture. So anyone who's actually thinking that logic through just needs to give their head a shake. So this has been a great company. It's a net beneficiary of AI. But at the end of that, it's a very profitable contract manufacturer. And I think the valuation is largely driven by ETFs. But that aside, good company, but at these levels, it's expensive.
Do you think that making that kind of announcement and not following through, and you said this has happened before, does that hit them at any point?
Well, I think you've got to be very, for example, if you look at the Zelensky interview from Friday,
yes,
when you're dealing with a Trump-type administration, someone who really likes to be say pampered. You've got to know how to kiss the ring. You know, the Japanese did it very successful and they had their meeting. And then you compare that to what Zelensky did. So, you know, I think what will happen is they will definitely spend some resources on facilitating that process. But there's not a cost advantage to actually building in the US. It's actually very expensive to build semiconductor foundries in the US, particularly leading edge. So I just don't see it happening. But there will be a protocol that has to be managed by the Taiwanese, and they've been very effective at managing that protocol.
Out of curiosity, why is it so much more expensive? Is it just, as you mentioned, permitting? Is it the resources that have to be pulled in? Why is it so much more expensive?
You've got cost. You've got the cost of construction for a start. You've got water treatment, EPA regulations. You've got the US does not have the volume of electrical engineers that Asia tends to have.
Okay.
So, for example, you know, I lived in Taiwan for 5 years, and you know, every second person I meet would be an electrical engineer. So there's a lot of semiconductor talent. So, you know, so you've got to have that capability. And then there's also the ecosystem relating to an industry. Do you have the support systems in place? And if not, they have to be built. Someone has to pay for that. So just because you say, oh, I'm going to build a plant, well, what about all the ecosystems that's relating to support that?
Yeah.
It's not that.
And it'll take years to get there. All right, let's go back to the emails now. We have one from AJ. He says, with all the global uncertainty right now, are we in a good buying position to purchase some large cap tech stocks like Microsoft and take a longer position? Good question, because, you know, if you do want to buy in now as things are dropping, but we don't know how long the tariff situation or the trade war is going to last. If it's going to escalate, you should be looking sort of longer term.
Yeah. Okay. So I suppose I'll sort of let the air out of the bag. This is actually our top pick for later in the show.
Got it.
So I'll talk that a little bit later in the show. But what I would flag is this stock is up 150% in 5 years. And if you had bought it 5 years ago, you would have got exposure with Canadian currency. So you'd get the magnification of the benefit. So I'll talk about it later in the show. But this is a quality name.
Okay. So Microsoft is something we will get to a little bit later. We also have one more email I think we can get to just before we go to a break. This one is from Lloyd. Could you please ask Darren about Lloyd's Bank now that it has broken out? Lloyd's Bank.
Lloyd's Bank, yeah. So I sort of touched on this a little bit earlier in the show. So you've got a UK banking system, you've got continental Europe, and you've got different regulators, obviously, and we know about Brexit. So the UK banks tend to be far more risk on, risk off, as the American banks are, right? So if you're looking for, you know, like, yes, it's had a nice little run from 25 to 40, but if you look at the history, the big question was, is now, have they sort of learned their lesson? Remember, they were owned by the state, right, not that long ago. And so the UK economy is not in great shape. So you've got to think through what end exposure do you want, and is that appropriate? So I would say Lloyd's Banking Group is an interesting company, but for me it's a trade, it's not an own. You know, if you're looking for real sustainable, low growth, low beta, but owned forever, Handelsbanken banking in the Nordics, but it doesn't grow very quickly. It's very, very slow. But if you're looking for higher growth, then you look at perhaps even to the insurance sector in Europe.
Got it. All right, we are going to take a quick break. We will be back with more of your questions in just a moment. Stay tuned. Welcome back. Thanks for joining us here on Market Call. We want to go straight to an email from Fred, very short and simple email saying, hello, Darren, is it not too late to trim your winners? I was wondering about that as well, because it's almost like you would have needed to act yesterday as opposed to today.
So, you know, we ran that exercise across our portfolio actually last PM meeting, which was, I think, last Wednesday. So we sit down and, you know, we tend to have longer term holds, 3 to 5 years. The longest single name we've owned is 28 years consistently. So in effect, what we had is 40% of our book was overweight. A couple of the very core names were in excess of 2x of our weight. So I think the question you've got to get to is, firstly, does the weighting continue to make sense? Does the holding continue to make sense? If the holding does not continue to make sense, then just take it off the table. Okay, and then if from a risk management point of view, you never go bankrupt taking a profit, right? And then you've got some cash reserves. So yes, the market has traded down a little bit now. If you've got some cash, it's going to position you to have currency to be able to buy opportunities and new opportunities. So what I don't favour is a lot of trading. What I do favour is just conventional risk management. And so when things go overweight, you trim them unless there's a good reason. But once they get to a certain threshold, you've got to cut them back. And so, it doesn't, it's not a market-specific pricing dynamic. It's actually a risk management consideration, and it's a core principle of portfolio building.
Let's go back to the phone lines, and we have Darren calling on the line from Edmonton today. Darren, what is your question?
Hi, I'm looking for information on Palantir Technology. Symbol is PLTR. I will hang up and listen. Thank you.
Okay, so the only thing I've got to say on Palantir, and you can see it right from the chart, the CEO, people didn't really know what their company did, and then the CEO went on TV and just shot himself in the head. The comments that he made really spooked the market, and investors started dumping the stock. They started to believe that he was a real loose cannon. So I think what I would say is this stock is now, from a PR perspective, in the penalty box. So it's had a great run, but you got to be really careful when your CEO starts going on TV and talking, making comments that are inappropriate.
And do you think it'll continue to be penalised?
Well, let's look at a couple of companies who've been offside. For example, Disney got hit with the anti-woke, and that really hit the stock. You've got Bud Light had the same issue. So the flavour of the day of why stocks get hit is not really relevant. It's just that when they get hit, they stay hit for a period of time, and you've got to go through this whole recuperative process. Procter & Gamble have been hit in the past as well. So if the stock continues to decline, but the fundamental performance continues to improve, then you can look and see, is there a disconnect and how long that disconnect takes. But in the current environment with tariffs, with Hurricane Donnie in place, doing what he's doing, I'd be more inclined to sell or not to buy at this point. Just wait and see.
Hurricane Donnie it is. Okay, let's go back to the phone line. Nelson's on the line from Vancouver. Hi, Nelson. What's your question today?
Hi, thank you for taking my call. Mm-hmm. I want to have the guest opinion on Ballard Power, BLDP. We trade both in Toronto and New York. The hydrogen cell technology seems to have a good future, but the stock keep on falling and falling. So I'm just wondering your input, please. Thank you.
Yeah.
So Ballard Power.
Yeah. So I think one of the big takeaways from the sort of the renewable exercise that everyone went through in the last few years, Greta Thunberg and what she was marketing, was that renewables at lower cost rates, lower cost of capital, just don't work, because you have to have the subsidies. But what does work, and what is going to be sufficient to create appropriate levels of power? And now hydrogen is obviously one. So Mitsui in the last couple of years put $10 billion. They spent $10 billion building a substantial megawatt energy plant. So I think large-scale projects for hydrogen really do work, and it will be an interesting opportunity. But small scale, I'm not so sure, the Ballard Power. So, and then the other question you've got to get to with hydrogen, I think the big question is who is the most appropriate to manage those types of that type of flammable liquid? Well, it's going to be the Shells, it's going to be the Suncors and those types of companies that have expertise with highly flammable chemicals, and also, more importantly, have the capital budgets to be able to build plants that cost $10 billion. So, Ballard Power, obviously a good Canadian company here, but the market's telling you that the solution they're selling is not appropriate for the current environment.
Got it. All right, let's go back to an email. This one is from Ken. Could I get your guest's opinion on European banks, which we did touch on already today, but specifically Banco Santander?
Banco Santander? I actually like Santander. If you look at the regulatory environment that it exists in within Spain, quite supportive. It has interesting operations. I think it's actually quite a well-run bank. And if I was looking for a growth bank, this is probably one I would actually take quite an interesting close look at. I think interest rates in Europe have obviously, they have definitely bottomed and they're moving up. And if we see tariff-driven inflation, all the banks will benefit. This bank over longer periods of time has actually done quite well. So I wouldn't say I'm banging the table here. It's not something we own, but I do like the name longer term.
Got it. Okay, we do have to take a quick break, and that is all the time we have for your phone calls today. But stick around. Our guests will share top picks when we come back. All right, time now for top picks here on Market Call. The first pick from our guest, Darren Sissons, is Canadian Apartment REIT. Why do you like this?
Yes. So at this point in the cycle, obviously with, as I mentioned, Hurricane Donny, I think we need to have some defensive repositioning in the portfolio. So we've added some defensive names. So in terms of Canadian Apartment REIT, the issues with regards to lower immigration and obviously rent control have weighed on the stock, which in my humble opinion, it's very attractively priced. It's got an attractive dividend. But what we are going to see is if we get a recession, people, if they don't pay the rent, they're going to get evicted. And then when people do move in a better economy, what you will see is those vacated rental units then being repriced at higher rents. So at these levels, you've got a very attractive entry level, you've got a sustainable business model, and you've got an environment that's going to be beneficial for tenants paying their rent. So at this level, I think it's going to be a good total return story moving forward.
Oh, yeah, I was going to say it's the right time right now to get into that.
Exactly.
Got it. Okay, let's move on to your second pick, which is Franco-Nevada Corporation. What do they do?
So Franco-Nevada is a company that buys the profit streams from miners. So effectively, think of it as a bank. Now, a little bit interesting, it's probably a Canadian national champion in terms of the mining space. It doesn't own mines, it owns the profit streams. It runs with no debt and has $1 billion worth of cash. So when the mining metal cycle is quite inexpensive, as we saw with the performance of BHP, and also with Shell, they will be buying royalty streams at inexpensive prices. When the resource economics improve, then what will happen, the profits from those inexpensive prices will then move up, their cash levels will move up, and as will their profitability. So that's what you get. So we entered that on the Cobre Panama sell-off, and the stock gapped down about $40 a share. That is now looks like it's moving towards a solution. So there could be $40 of upside impact on the share price. So we've done very well with it. We like it. I think this is a long-term core holding, and I do think it's a Canadian national champion myself.
Got it. All right, let's get to your last pick, which we did touch on earlier today, which is Microsoft. And why, of the lovely seven, have you picked Microsoft? Okay, so
there's a couple of dimensions to this. So obviously a lot of cash, downside protection. You've got the monopolistic Office products which give you downside protection, but then you also have some growth via the Gen AI products and obviously the cloud. So that will give you some upside catalyst, and that's going to be moving forward. The OpenAI product, if it was to IPO, is worth about $13 billion, which in round numbers is probably somewhat of a rounding error, but it might be nice cash. So I do think you're going to have a defensive positioning for something that's going to grow. The growth might slow, but what you will see is even if we get a correction in the pricing, you'll see the stock slowly move up over time. And if you look back to sort of 2000 and think about all the champions, the ones that survived and didn't, probably the two that stand out would be Oracle and Microsoft. Right? But they did have a period of dead money. So from here, we think this is an attractive entry.
There was a while where people like Microsoft was very much fading.
Correct.
And people were asking the question of, okay, what are we moving forward with? And then it sort of turned around for them.
And now they obviously have cloud, which is obviously very, very strong earnings there. And then you've got the OpenAI or the Gen AI type suite of products, which is, as we talked about, Taiwan Semiconductor has been the real catalyst for that business. So, obviously some big opportunities moving forward.
Got it. Okay, I'm going to take a look at the markets, but I'm hoping you can look at them as well and give me sort of your running commentary as we take a look, because we know we're in the red and people are nervous. Investors are worried, of course, as they watch their stocks fall today. We knew it would happen if the tariffs came in. Clearly it is. We have the TSX down 447 points. We have S&P not too bad at 70 points. And NASDAQ has recovered actually somewhat at 115. So we're seeing a bit of a bounce back, a much bigger drop earlier in the day. So what's your take on this?
Well, NASDAQ's down less than 1%. S&P a little bit over 1, and the TSX, which is commodity heavy, is down less than 2. I think on balance, not too bad. Particularly for longer term exposed investors, and so we are a 3 to 5 year type of time frame. So what I would be looking at these levels is, firstly, are there any opportunities? What's on your wish list? And if there is a continuation of downward pressure, perhaps put a little bit of work, a little bit of cash to work. Make sure you've trimmed and have some cash reserves. But on a day like today, where we've had the tariff announcements, the market's hardly down.
Yeah.
Really.
So, which maybe people haven't settled in with it. Do you expect it to go further down before we straighten out? And I've got like 15, 20 seconds.
If you've got US exposure, European exposure, and our Canadian dollar reprices lower off this, that's a benefit to your portfolio, right?
Got it.
So I'm not super concerned at this point.
Darren Sissons, thanks for coming in. Appreciate your time and what has been an up and down market day so far. We'll see you soon, and that's all the time we have for Market Call. Thanks for joining us. We'll see you tomorrow.